All right, let's dive into one of the most confusing market reactions we've seen this earnings season. We're talking about SFL Corporation. They just reported their Q2 2025 results, and, on the surface, everything looked pretty decent. But the market? Well, the market told a completely different and, frankly, a much more brutal story. So let's get into this paradox.
Okay, so let's start with the big headline number. SFL reported a GAAP EPS of 1 cent per share. Now, that might not sound like a lot, but you have to remember, Wall Street was actually expecting a loss of 3 to 5 cents. So this was a solid beat. We're talking 4 to 6 cents better than anyone was hoping for.
And this is where things get really weird. Despite that beat, the stock got absolutely hammered. By the time the market closed, shares had plummeted nearly 17%. And the trading volume? It was insane, like 7 to 12 times the normal average. So, just to be crystal clear, the company beat expectations, but the stock got crushed. That's the puzzle we need to solve today.
So this is the million-dollar question, right? Something seriously spooked investors, and it clearly wasn't the earnings per share number. The market was reacting to a whole other story, one that was kind of buried just below the surface.
And looking at the results just makes it more confusing. The EPS beat we just talked about. Revenue came in a little ahead of schedule at $192.6 million, and adjusted EBITDA was a really healthy $112 million. By all the usual metrics, this should have been a great day for the stock.
And here it is. This is the reveal. For a company like SFL, which has tons of investors who are in it for the income, the earnings number isn't always the main event. The real story, the thing that caused that 17% nosedive, was all about the dividend. The board slashed the quarterly dividend from 27 cents all the way down to 20 cents per share. That's a reduction of about 26%. For anyone holding the stock for the yield, that is a massive red flag. It triggered an immediate sell-off. But the real question is, why'd they do it? This quote from the CEO Udilaco on the earnings call really gets to the heart of it. The cut wasn't random. It was a direct response to a specific problem asset that just wasn't generating any cash. He said it was prudent, which is basically corporate speak for we had to align our payout with the cash we're actually making.
So this unit the CEO mentioned is what's called a warm-stacked rig, and it's super important to understand what that means. Think of it like this. A rig is warm-stacked when it's not working. So it's not earning you any money, but you're still spending a ton of cash every single day to keep it maintained and ready to go. It's really the worst of both worlds. All the cost, none of the revenue.
The rig we're talking about is the Hercules, and its situation is pretty grim. It's been sitting idle since late 2024, and it's costing the company about $60,000 a day just in operating expenses. That doesn't even count financing costs. That is a huge, continuous drain on their cash.
And just look at this financial swing. It is wild. In its last full quarter of work, the Hercules brought in a massive $35 million to EBITDA. Now, in Q2, it was a nearly $5 million drag. That's a $40 million negative swing from just one single asset. And when you see that, the dividend cut starts to make a whole lot more sense. So that's the bad news. That's what the market reacted to. But here's where the story gets way more interesting. While investors were panic selling the stock because of the Hercules problem, management was busy playing chess, executing a much bigger strategic shift to make the company safer and stronger for the long haul. Let's walk through their three-part plan. First, they cleaned house. They got rid of 20 older, less efficient ships, and that brought in over $200 million in cash. Second, this made the company way less risky by lowering the fleet's average age and, this is a big one, getting rid of the last of their related party deals. And third, they're taking that cash and redeploying it into brand new, long-term contracts. And the result of all that hard work is this number. SFL has built a fixed-rate charter backlog of $4.2 billion. Honestly, this is the single most important number for understanding the long-term health of this company. It's contracted, predictable revenue for years and years to come. And it's the quality of this backlog that really makes you take notice. 2/3 of that $4.2 billion is with investment-grade companies. We're talking about the super reliable blue-chip customers, like the shipping giant Maersk. This isn't some speculative hope for revenue. It's locked in and de-risked. So that brings us right here to the final analysis. We have short-term pain from one idle rig and a dividend cut, and we have a long-term strategic pivot towards a massive, super high-quality backlog. How do you trade that disconnect? Well, from here on out, we're putting on our analyst hat for the next call. Our first trade idea is one we're calling the backlog buffet. It's a pretty straightforward bullish idea.
And it's based on the theory that the market made a classic mistake. It punished a company for a short-term problem while completely ignoring its long-term strength.
The thinking here is simple. That 17% drop was a huge overreaction. SFL was basically transforming itself from a company you just buy for the dividend into a durable, almost utility-like infrastructure play. That $4.2 billion in contracted revenue gives it a kind of cash flow visibility that is now deeply undervalued after that sell-off. This is really a bet that the market will eventually recognize the quality of the business over the noise from one rig.
Now, our second idea is a little more sophisticated. It's for those of you who want to bet on the core strength of SFL's business while hedging out the specific risk from the offshore drilling market. We call it the Hercules hedge.
Here's how it works. You go long on SFL, and at the same time, you short a more volatile pure-play drilling company. This is designed to let you profit from the strength of SFL's core shipping backlog, which is what you really want. If the rig market gets even worse, your short position protects you. But if the Hercules surprisingly finds a contract, SFL gets a massive positive catalyst, and your long position should absolutely rocket higher.
So, what's our final verdict? Based on all this, our official Talk Tickers rating for SFL is outperform. We really believe the market's tunnel vision on the dividend cut has created a compelling opportunity. The underlying strategic move towards a high-quality long-term backlog is being totally overlooked.
So if there's one key takeaway, it's this. The market sold the headline, and that headline was the dividend cut. That action, we think, created an opportunity to buy the real story, which is the company's strategic transformation into a more resilient, predictable business.
And we'll leave you with this final question to think about. The race is officially on. What's going to happen first? Will the market wake up and realize the incredible, understated value of that $4.2 billion backlog? Or will the Hercules rig find a new job first, removing the problem and forcing a re-rating? The timing is uncertain, but the value seems pretty clear.
And as always, we have to say it, this is not financial advice. This explainer is for informational purposes only. Please do your own research before making any investment decisions.